Ladies and gentlemen, good day and welcome to the Globus Spirits Limited Q3 FY22 earnings conference call. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note this conference is being recorded. Due to time constraint, this call will be for 45 minutes. And I would like to hand the conference over to Mr. Shekhar Swarup, Joint Managing Director, Globus Spirits. Thank you, and over to you, sir.
Good evening, everyone, and thank you for joining us today. Unfortunately, we are a little bit constrained on time today. As a result, we have limited this call to about 45 minutes. I hope you've been able to see the results, even though they were published just a short while ago. Let me now take you through what has happened in the quarter gone by. Our consistent focus at the company remains to grow both arms of our two-pronged business model. In the past few quarters, as you would have seen, we've concentrated our efforts at growing our capability in our consumer business to serve as a platform for future growth while leveraging our 3 decades of operational capabilities towards the emerging alcohol deficit on the back of high procurement of ethanol for fuel blending. This two-pronged approach has helped us deliver consistent performance and is poised well for further growth in the coming years. In Q3, the consumer segment continued to perform as per expectations, and our volumes were 37.3 lakh cases, flat Q-on-Q due to seasonal variations, and 13% growth year-on-year, with Value Plus segment continuing to drive growth. In a short while, Param will take you through more details of the consumer business's performance. In our distillery segments, low capacity utilizations in Q3 has been seen, with our Haryana plant being closed for nearly 40 days due to major planned overhaul in our power plant. And our Bihar plant continued to be impacted with floods in the region for 72 days in the last quarter. Put together, the company saw an opportunity loss of 25 crore rupees in our EBITDA in the quarter gone by. Both plants are now running at full capacity since around mid-December. Q3 also saw the completion of our West Bengal capacity expansion, which since then has been running at 100% capacity utilization. Fuel cost inflation was also a significant concern in Q3, something that affected all industries in India. We saw inflation of fuel costs as high as 18% at its peak in the last quarter. This rapid increase in costs could not entirely be passed on to ENA customers in Q3. However, the increase in ethanol rates from 51.55 rupees per litre to nearly 53 rupees per litre have helped cover up some of this cost increase. Going forward, the company has decided to increase supply of ethanol made from surplus rice, which has secure margins to a large extent, as raw material is purchased at fixed prices from the Food Corporation of India. Between 1st December 2021 and 30th November 2022, we will see 36% of total current capacity supplied to OMCs as ethanol, of which 18%, so half of the total ethanol supply, will be made from surplus rice. OMCs are also evaluating a process of allowing companies to transfer quantities between the 2 types of ethanol, damaged grain and surplus rice. And we are remaining watchful of inflation in grain costs and will shift to surplus rice ethanol if costs continue to rise. As you're all aware, a little bit of an update on our expansion plans now. As you're aware, the ethanol blending program is doing well, with E10 being available in almost all petrol pumps in the country. The next milestone for this program is E20, which OMCs have been mandated to transition to by the year 2025. To that end, Globus Spirits has plans to leverage further leverage its capabilities in setting up low-cost plants that operate at higher than industry efficiencies. With the recently commissioned project in West Bengal, our total capacities for ENA plus ethanol are now at 670 KL, which was earlier 530 KL per day. Work at the Jharkhand factory is underway, and Odisha land acquisition is also underway. Today, I am also pleased to inform you that the Board of Directors has approved the setting up of 2 new facilities of 140 KL each, one in Uttar Pradesh that is being built for ENA, ethanol and consumer business within the state, for which land acquisition is underway, and we will keep you informed of progress. The second project is another 140 KL plant, which will be a brownfield expansion at one of our existing locations. This expansion will be dedicated for ethanol. With these planned expansion projects in process, we expect Jharkhand, which is 140 KL, to be commissioned in Q1 of the coming year. A new brownfield to be commissioned in Q1 of the next year, and UP and Odisha will come up later in 2023-24 and early 2024-25. Thereafter, our total capacity will go up from 670 KL per day currently to 1,230 KL per day. Financing of these projects is being planned from internal accruals and some debt, which is approved under the interest subvention scheme of the Government of India, under which our net interest rate is 3.85% per year. We expect each 140 KLPD project to cost us rupees 120 crores as compared to about 200 crores, which is the cost for most other companies. As mentioned earlier, we will continue to keep you informed of progress and capital allocations being made in the subsequent quarterly updates. I now request Param to take you through the performance of the consumer business in the quarter gone by.
Thanks, Shekhar. Good evening, ladies and gentlemen, and I hope you and your families are keeping safe. As Shekhar explained, our consumer business has been seeing continued strong traction with growth in volumes by 12% year on year, with the value plus segment showing a healthy 58% growth. On a 9-month basis, the volumes grew by a healthy 32%, while revenues by 41% on account of higher realization and increased value plus sales. We are well on our path of a strong growth trajectory for the forthcoming quarters as well, with our product mix continuing to improve with a higher share coming through the premiumization from the value segment. A quick analysis and strategy for this segment. For our value and value plus, the key markets of Rajasthan, Haryana and West Bengal continue to show growth. In Rajasthan, our market share has increased to almost 32.5% on the back of strong performance of the value plus segment, where our market share has increased to almost 45% in the Q3 of the current year. This was in the range of about 30 to 35% during last year. The Black Lace rum that has been in the works was launched in Q3 22 and has been well received. We are on track to launch an additional whiskey brand as well that is now being scheduled for the first quarter of 23. We continue to expand whiskey and vodka offerings via Tetra Packs as well. Tetra Pak, as you know, is an interesting modern offering which is not only putting forward an efficiently transportable option to the market, but it also is the most pilfer-proof packaging around in the consumer business. It also offers significant advantages to the traveling and mobile consumer. This move also, in a way, establishes our ability to move forward to try and capture new modern trends, hoping that we will ride the early wins in some of these consumer behaviors. In Haryana, we have maintained the market share in the range of about 9% and have launched 2 brands in the value plus segment, which is called Metro Liquor, earlier this year. This has seen a positive initial response from the market. The new offerings which have been planned will again play into the accretion of our margins as well as build our overall market share. Both offerings are in the whiskey flavor, which is the most dominant flavor in that market. In West Bengal, where there is a huge headroom for growth because our current market share is only about 2%, our upcoming expansion at the West Bengal facility gives us a huge opportunity to capture this at the front end of the business. Our reintroduction of the original Goldie brand in the market, basis initial feedback, has been very positive. We expect to grow our portfolio there as well through an introduction of an additional value plus category, which has been introduced by the excise a quarter ago, and this should lead us to additional volumes as well as accretive margins in the months to come. We have also successfully started energizing our current portfolio across the chain by not only improving its overall delivery to the consumer, but also expanding and upgrading the range of our offerings to continue creating for evolving tastes and preferences of the evolving consumer. Global Spirits will continue to participate as a meaningful business in the premium and core segment as well, given the potential of the industry and the economic benefits that accrue to the players in this segment. In the IMFL business, as earlier mentioned, our philosophy of playing where we have a right to win depending on the ease of entry, cost of doing business, better contributions and business environment is progressing well. We are about to go in for local production of our vans in West Bengal as we speak to you. This will allow us to expand quickly and efficiently in the whole state and in the future also pave the way for us expanding into other eastern markets. Currently, we have only been servicing the Greater Calcutta area because we did not have local servicing available. Key markets of Delhi, UP and Haryana will see our brands enter between Q3 of this year and Q4 of the current year through in-house sourcing, which is just around the corner and will be a very meaningful phase in our journey. In the IMFL segment, we are also working hard to increase our offerings so that we can also improve our participation in the larger spread of the markets. In semi-premium segment, we are ready to put our offering on the table in these markets where we are entering in these quarters. We are also very confident of adding to our portfolio other segments as soon as the runway for these markets is established. I will request Dr. Roy to now lead the conversation. Dr. Roy, please.
Thank you, sir. Good evening, everyone. Let me now take you through the operational and financial performance of the company. Before we discuss our performance in the third quarter, please note that the reported financials for Quarter 3 FY22 and 9 months FY22 include the effects of the merger of Unilever Limited with Globus Spirits Limited, and accordingly the financials for previous comparative periods have also been restated to ensure like-to-like comparison. Share of consumer business increased by 500 bps year-to-year from 45% in Q3 of FY21 to 50% in Q3 of FY22. In the consumer segment, we have seen a volume growth of almost 12% year-to-year to 3.7 million cases and realization growth of 10% year-to-year to rupees 463 per case. The manufacturing business, on the other hand, while growing on year-to-date basis, was impacted in Q3 FY20 due to shutdown of Bihar plant on account of flood situation, which was restarted on 12 December 21, and also intermittent stoppages, majorly in October 21 in the Haryana plant on account of plant maintenance, which led to a combined contribution loss of around 25 crores. However, both the plants are running as per normal capacity in the current quarter from January 22 with no stoppages. Despite this, the overall capacity utilization stood at almost 87% in Q3 FY22, which will be in full capacity in Q4, coupled with the fact that Bengal will be operating on the additional capacity of 140 KLPD. Within the manufacturing segment, bulk alcohol revenue came in at rupees 124 crore for Q3 FY22 as against rupees 135 crore in Q3 FY21 and rupees 416 crore in 9 month 22 versus rupees 396 crores 9 month 21, thereby representing a growth of 5% on a 9-month period. In terms of volume, the consumer segment saw sales of 3.73 million cases in Q3 of FY22, a growth of 12% year-to-year and almost flat quarter-to-quarter. On this, value plus segment 1.20 million cases in Q3 FY22, which was 0.76 million cases in Q3 of FY21, a growth of 58% year-on-year. For 9 months 22, the overall consumer segment volume stood at 10.9 million cases, growth of 32% year-to-year, of which value plus segment sales were 3.67 million cases, growth of over 90% year-on-year. Our cash flow generation in FY21 was strong, and we generated rupees 148 crore of net cash flow.
From the OMCs for the current ethanol supply year, acknowledging the fact that there has been cost pushes in the industry.
Right. And one last one, if I can. Just wanted to understand whether is there any constraint to our sourcing of inputs. For example, the broken rice or food grains for manufacturing of our.
No, there's plenty of raw material available in India. But of course it's an agri commodity, so every year it is dependent on the crop cycles. There is plenty of raw material available with FCI. There's plenty of raw material available in the open market between maize, millets, broken rice, and that's another reason why the company believes in setting up small to mid-sized capacities in multiple states rather than have a very large capacity in a few areas. We get a good hedge in terms of geographical spread and availability of raw material as well.
Right, because why I was coming to this question is because a lot of distilleries are now trying to become a fungible kind of a distilleries where they can shift to grain-based manufacturing as well. So over the period of time, this would be some kind of a risk for us. I was just trying to understand from that.
I think you're talking about a very long period of time, and up to 20% ethanol. I don't see this to be a major issue. We have to see if there are plans to go to E30, E40 or E50, then perhaps these things will also come into consideration.
Sure. Thanks for the understanding and all the best for you.
Thank you. Ladies and gentlemen, please restrict questions to 2 per participant. We have next question from the line of Vivek Gautam from GS Investments. Please go ahead.
Sir, this quarter, to be honest, has been a bit of a dampener. So in terms of margins and the losses, so can you just throw some light on what was the tax expenses which led to this, and this is a one-off sort of a thing or structural downward trend, or this is?
There are 2 types of events that have taken place in the quarter. One is unavailability of our capacities in Haryana and Bihar, which led to a EBITDA loss of 25 crores. The other is increase in costs, especially in Haryana, due to our entire consumer business in Q3 in Haryana for about 50% of the time had to shift to purchased ENA, and that impacted margins dramatically, obviously. And third is an increase in fuel costs, which is I think known to everybody, that took place in Q3 due to huge fuel shortages in India in the month of I think it was October, November, and continued till early December. So these are the factors that affected our performance in Q3. Fundamentally speaking, these are these are not changing our business fundamentals. They are obviously a blip in, we have demonstrated several quarters of a one-way trajectory. It's obviously a blip in that trajectory, but it does not impact our business fundamentals.
So how is the situation now? It's much better?
The increase in costs on fuel has stopped. The fuel costs have sustained at a certain level. We've received price increases in ethanol, which have compensated for that. Packaging costs, there was some inflation, but that has been arrested. There's no further inflation. So, I believe all of these inflations has been factored into our business. Where price increases could happen, they have. And I maintain that Q4 of last financial year level of profitability is sustainable, and we've been sustaining it for all of this year, except obviously Q3 for the reasons mentioned before.
My second question is about our capex plan. So our company had suffered in the past due to the aggressive capex plan, if we remember, and having learned the lessons from that, are we going in a measured manner, and our ROC would still remain at a respectable number?
So most of our, according to our conservative projections, which is below the level that I have said to you, our paybacks on these projects is around 3 years. And considering that we have debt available at the rates we do, the return on equity is very, very attractive. Plus the offtake of our product is assured from the OMCs. We have long-term purchase contracts in some states that the OMCs have given us, 10-year, I think it's 8 or a 10-year long-term purchase contract. So, risk reward is very much on our side.
UP, the land has been finalized for the capex plan, and
we've identified the land, and we are working on land acquisition. We've identified land, and we are working on acquisition.
Near to our Muzaffarnagar area only, where
no,
we had our
central UP.
Thank you, sir. Keep up the good work. Thank you. Bye.
Thank you. We have next question from the line of Anshul Vadia with Edelweiss Wealth Research. Please go ahead.
Thank you. Thank you, Shekharji, for taking the question. Just a couple of it. First, your PPT says that we are taking a price hike. The government is giving a price hike on IML and RML. So largely, if I do a rough math, it would be 4 rupees per litre and 2 rupees per litre on the value plus segments. So how do you see this contributing to the margins next year? Because this, if on the face, looks a big number, when your realization per litre is 40 and 4 rupees price hike you are seeing. So will it be more than...
Hang on. So 40 rupees is the price increase per case for value plus, and 20 rupees, 39 and 19. 19 is for the value segment. There are 4 liters of alcohol that go into a case of value plus. That's 10 rupees a liter. And in case of value, there are 3 liters of alcohol. So that's it's shy of 7 rupees a liter.
Yep, that's helpful. So, my follow-up is that, so this price hike would be more than enough to offset the raw material cost inflation and the fuel cost we have.
This will lead to profit growth. That is what we are expecting.
And your thoughts on animal feed? We have these prices are normalized, and these directly impact our manufacturing margins. So, is it possible to tell us what was the average realization in this quarter on DDGS front?
Sure, I can. In the last quarter update, I had mentioned that AFS prices have gone up dramatically in the quarter, and I had said that the levels were not sustainable. And as per expectations, this quarter they have cooled off a bit. So currently the prices are around 30 to 32 rupees a kilo versus about 45 rupees, which was the average for Q2. This level is, in my view, very sustainable going forward.
That's helpful. So just last question from my side. the volumes were flat in this quarter if we compare with last quarter. So in your initial remark, you said there are some seasonal trends. So could you elaborate on that? And also in Rajasthan, we are largely we have garnered a large chunk of the market. So from where the consumer segment will see the growth in the coming years? That's all I say. Thank you.
Param, can I ask you to take that, please?
Yeah. So, first thing is as we have said, we are expecting the value segment to open up in Haryana, to open up in West Bengal. Both these markets are going to add to the growth from our point of view. In addition, as we are also expecting our IMFL business to start kicking in from February, and while initially it will be significantly small in terms of bringing in revenue growth, but it is the basis on which acceleration will happen. So from that point of view, we are as of now fairly comfortable that we can continue on our upward growth trajectory as we keep going forward.
Thank you. That's helpful.
Thank you. We have next question from the line of Nitin Awasthi from InCred Equities. Please go ahead.
Hello, sir. The first question would be on UP expansion. You always have stated that the way you select states to expand into is you look at the right to win. But this state seems very, very crowded. It has all the sugar mills who are now bought into the Indian-made Indian liquor segment.
Operations. Whereas for 9 months ended FY22, the cash flow generation was rupees 156 crores. Our finance costs are reduced by 41% year-on-year from rupees 14.7 crore in 9 months FY22 to rupees 8.7 crore in 9 months FY22 on the back of reduced debt as mentioned above and reduced average cost of debt to 4.7% in 9 months FY22. Our interest cost for the last quarter is 4.7% on long-term loan as a result of improvement in the financial risk profile of the company, marked by healthy operations margins and comfortable capital structure and debt coverage indicators. The credit rating of our long-term and short-term bank facility stands reaffirmed, that is stable with a positive outlook. We saw our EBITDA margins improve by almost 300 bps year-on-year to 23% in 9 months FY22, despite lower margins in quarter 3 FY22. As mentioned earlier, the inflationary input cost scenario coupled with unavailability of part of our capacity leading to lower absorption of fixed costs impacted our profit margin in quarter 3 FY22. Higher contribution from consumer segment and better bulk alcohol realization did offset the inflationary process to some extent. Going forward, with both Haryana and Bihar plants back in action and additional capacity of 140 KLPD in West Bengal, we believe that the enhanced scale of operations should be able to absorb the impact of rising input costs. Our effective tax rate, which is on the basis of cash outflow of tax paid, is at 21.7% due to available MAT credit. Management is contemplating to shift to the new regime of computation of tax under Section 115, where the tax rate will be 25.60%. Now coming to the working capital cycle, our overall working capital cycle has seen an improvement in 9 months FY22. However, there is an increase in accounts receivable on account of strong growth in higher price of consumer value segment, of which the duty paid is funded by the company. The net working capital days is 15 days as of now, despite this increase in working capital. Our return ratios have significant expansion. ROE have gone up from single digit in FY 2019 to 19% in 9 months ended FY22. We have calibrated our operations to ensure that any disruptions are not only temporary but can also resume quickly. As a result, we believe we are in a strong position. This concludes my reports on the operational and financial highlights. I would now request the moderator to open the forum for questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone now. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star followed by 1 on your touchtone phone now. We have a first question from the line of Prithviraj with Unifi Capital. Please go ahead.
Hi, Shekhar. So the first question on your ENA sales, given that, so the Bihar plant is fully operating and Haryana is back to operations and you have West Bengal new capex. So what kind of volume run rate can we look at, say, from Q4 onwards in the ENA sales?
So it's difficult for me to talk only about ENA sales, I will, however, attempt to answer that from a production of ENA plus ethanol point of view. We are now running at 670 KL per day of capacity, which is our installed capacity. We are running at 100%. So, on a 90-day kind of basis, one should assume over 95% of our installed capacity as our capacity utilization.
Shekhar, so my question is, how much of this will be used internally and how much is for external sales?
So, internally will be around, I'll have to do the numbers and get back to you, but around 40% will be internal is an approximate figure that I can give you right now.
Okay, fine. Second, coming to your margins, you've got few price hikes in Rajasthan, but given that the inflation still exists, how much of the cost increase you have passed on to the customers and, how do we see margins going forward?
As you're aware, Prithvi, ethanol is a fixed price business. Our consumer business is also a fixed price business for the year. ENA is where we have some room to change our prices from time to time. As mentioned in my opening remarks, the inflation we saw in Q3 was very, very quick, and the increase in selling prices was gradual. A lot of that increase has now happened. There's also been increase in ethanol rates starting 1st of December. So all of that put together, our targeted EBITDA margins, which I have always said should be around Q4 of last year, we are, in line with that.
Okay, so from Q4 of this year, you will be at 24 to 25% of EBITDA margin. Am I correct?
I think Q4 of last year, I don't know what that number was, but Q4 of last year is what we expect as our sustainable EBITDA margins.
So just one final question from my side. You announced again 2 more capex in UP and 1 brownfield expansion. So, what is that driving you? Because you already have Odisha, Jharkhand in line and now another 2 new capex. What kind of opportunities are you looking in the industry? What is driving you to announce, such a huge capex?
Well, what drives me is growth here. So we see opportunity for profitable growth, and that is what is driving us. Plus the company is generating free cash, and we would like to deploy that free cash into our consumer business as well as our manufacturing business. Our consumer business currently does not require the kind of cash that is available, and as a result, the balance is being put to use in the manufacturing business.
And is it possible to give a brief?
I'm sorry to interrupt, sir. Would you like to come back in the question queue, please? Suraj?
Sure.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, kindly restrict questions to 2 per participant. If you still have more questions, please join the queue afresh. We have next question from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
So I just have one question. Because of this closure of Bihar plant and the Haryana plant during the quarter, what was the revenue and volume loss for your bulk alcohol business?
I don't have a calculation on the revenue, and we've given the days of loss. Bihar was 72 and Haryana was about 40. And Haryana, our capacity is about 150 KL per day. And in Bihar, our capacity is around 85 KL per day. So the rest can be computed quite easily.
Right. And with now West Bengal facility coming up, so as you said that from Q4 you will see normalization in terms of from ethanol is expected to increase in the coming years. So considering that, will this margin trajectory would improve on year-on-year basis, or do you expect it to remain at around 24 to 25%?
Yeah, so I've always maintained this. It is a commodity dependent business, and inflation can play a significant role. One hedge that we have on that is increasing our allocation of ethanol that we make from surplus rice that we get from FCI. That's obviously at a fixed price. We're also working on linkages with coal companies in India for captive power plant projects like ours. Hopefully later this year that will come through and we'll be able to save some fuel costs there. But Q4 of last year is something that I expect will sustain for the short to medium term for our industry. And, I think it was also very encouraging to see pricing.
So hence, just could you elaborate why UP?
UP is, according to us, is going to be undergoing a significant shift in the consumer business. We believe that in a few years, the entire industry of UP, both value plus, and IMFL, all three segments rather, are going to move from molasses-based ENA to grain-based ENA. As the sugar mills are reducing their availability of molasses, are converting their sugar into ethanol. Molasses availability in the market is reducing dramatically. As a result, standalone distilleries will no longer have raw material available. Therefore, the entire state is going to move towards grain-based alcohol for consumer business. You're also right that sugar mills are moving into consumer business, but frankly, they have not had much success on this. Our brands do have some recall in UP, whereas we are not operating in UP, we are operating in border areas of UP. So we believe we can create a good consumer business in the state. Moreover, UP is the largest state for the consumer business in India, if you look at all three segments put together. And for Globus, it is imperative to find a way to succeed in this state. And for that reason, setting up a capacity at a strategically good location such as central UP, which has grain, it has availability of sugarcane, whereas we don't have any plans for sugarcane as of now. But it will form a very solid foundation for the company to create growth in the times to come.
Noted and understood, sir. The second question would simply be, what would be the ENA prices prevailing roughly in the state of West Bengal as of now?
West Bengal ENA prices are prevailing around 53 to 54 rupees.
Okay, sir. Thank you. That's all from my side.
Thank you. We have next question from the line of Sunil Jain from Nirmal Bang. Please go ahead.
Yeah, thank you very much for taking my question. Sir, my question relates to more of the rice which you procured, waste rice and broken rice. So you had commented a bit in your opening remark. So how is the availability? Is there any change in that availability, or there is some inflation which is going on?
No, there is inflation going on, and as of now, the increases in costs and the increases in prices that we've received from OMCs, as well as what we've been able to sort of ENA market, have taken care of the cost pushes. As mentioned, in Q3, the increases that happened in costs were very quick, and we could not pass them through entirely. But now, to a large extent, they have been passed through. However, we remain watchful of inflation, and if required, we will shift more of our capacity to surplus rice from damaged rice in order to create a hedge on this inflation in damaged rice.
So this surplus rice which you may be procuring from Food Corporation, so there the economics or profitability or whatever your EBITDA margin will be similar, or it can vary?
No, that depends on the damaged grain prices, right? So currently it is slightly more profitable to make ethanol from damaged grains. But if this increases further, if the inflation continues, then that will get wiped out. So, it really depends on inflation, and that's why there is a hedge.
So that was my question. Like, if suppose you have to shift to, say, a surplus rice, then how much impact from your Q4, which you are guiding, EBITDA margin can come?
Like I mentioned, Q4 of last year is what we expect will sustain regardless of which raw material we use.
Oh, okay.
And, because inflation in grain also means inflation in animal feed supplements, DDGS or animal feed supplement.
Okay. And second question relate to again the availability of raw materials. See, lot of capacity being announced. So from here, say maybe 3 years after, all the capacity will be in place. So at that time, will we have so much surplus rice or whatever?
I don't see any issue in availability of raw material in India. We are continuing to export a lot of raw material. There's also very, very large amounts of stock of FCI. Plus, we have the ability to make ethanol from corn or from millets. All of these plants are multi-grain plants. So I don't see any issue in the next 3-4 years.
Okay, great, sir. Thank you very much, and all the best.
Thank you. We have next question from the line of Agastya Dave from CAO Capital. Please go ahead.
Am I audible?
Yes, sir. Please go ahead.
Thank you very much, Shekhar. Shekhar, you've answered most of the questions and in quite a bit detail. Sir, I have just two questions on the non-grain inflation part. So on the fuel and power cost, you mentioned that you may be going for a captive power plant in the future. So can you just take us through the inflation trends?
No, we actually do have captive power plants in all of our facilities.
Right.
We are evaluating going in for linkages with coal companies to procure coal, which will sort of insulate us from fluctuations in fuel cost.
Sir, as of now, what you are seeing, how much have you seen YOY inflation in your power and fuel costs?
So last quarter, the inflation was as high, it went up to close to 20%. I think 18% is what I said in the opening remarks.
Right.
It didn't sustain at that level, but 15% or so is the sustained level even today.
Right. So is that the reason why we see a spike in the other expenses, or are there any one-off items there? So the other expenses...
No, there are no one-off items. There are 2 or 3 reasons for that. One is, of course, this is a very large chunk of that. The second is our franchise bottling business saw a significant growth last quarter.
Right.
And there are some expenses related to that business which get classified as other expenses.
Right.
And third, for our Haryana business, we were short on extra neutral alcohol because our facility was closed.
Right.
So for our brands, we needed to purchase extra neutral alcohol, which resulted in erosion of margins and increase in other expenses.
Right. So that's not really included in the 25 crore EBITDA level hit you have taken, right? That's purely...
No.
Right.
No, that's not there, no.
That's not there. So my second question is, on this current base of 670 KLPD, And then subsequently, when you expand to the full 1230 KLPD, what would be the depreciation rates for the new plants? So currently, you guys are doing 10 crores a quarter. So how will
I
that?
don't know this. In interest of time, is it possible for us to get back to you on this later?
Sure, sir. I'll take it later. Thank you very much, sir, and all the best, sir.
Thank you. Moderator, maybe we can have a last question, please.
Sure, sir. Thank you. We have last question from the line of Riken Gopani from Capri Global. Please go ahead.
Yeah, hi. Thank you so much for taking my question. I just have one question, which is if you could elaborate more on the RML segment and how it is evolving in other markets and, in terms of regulations, what do you see as opportunity in the next year?
Thank you. Param, could you please?
Yeah, thanks, Mr. Riten. So, as we are noticing, state after state, they are seeing an opportunity to increase their revenue alongside an opportunity to offer the consumer a much more evolved and a better brand in terms of liquid and delivery. So earlier, obviously, excise and various states have been struggling how to increase their revenue on the value segment. So this is offering a pathway, and we are seeing a lot of positivity from states to start exploring this. A state like Rajasthan has obviously done the trick, and they are already in a stable state. And states like Haryana, UP, and West Bengal are on the early journey. And I see this process only accelerating because the base of the pyramid, which is the value segment, is still huge multiples of the volume which the value plus segment has reached up to now. So I see a lot of positivity in terms of opportunity as well as the state's intent to accelerate this journey because it is good for the consumer as well as beneficial for the state.
Thank you, sir. That was very helpful. Thank you.
Thank you.
Okay. Thank you, everybody, for joining us today. And again, I apologize for being very quick and hurried today. It's due to other engagements of the management team. If there are further questions that we've not taken on, please do reach out to us on our investor relations team as well as our investor relations agency, Stella, and we'd be happy to give you the answers. Thank you again and wish you a good weekend.
Thank you very much, sir. Ladies and gentlemen, on behalf of Globus Spirits Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect.